This strategy comes from Keller and Keuning's 2016 paper on Protective Asset Allocation, or PAA. It was designed for investors who want something that behaves more like an absolute return approach, meaning fewer deep drawdowns, while still aiming for strong long-term growth. The key twist is crash protection that can move heavily, or even fully, into safe Treasury bonds when markets turn broadly bearish. PAA combines two very intuitive momentum concepts. First, absolute momentum. If an asset is trending up, it's eligible. If it's trending down, it's avoided. Second, relative momentum. Among the assets that are trending up, you rotate into the strongest ones. So you're not just buying and holding, you're staying with strength and stepping away from weakness. Instead of complicated indicators, PAA uses a moving average style test. The paper defines a momentum score as today's price compared to a moving average of past prices. If the price is above its moving average, momentum is positive. That asset is considered good. If the price is at or below, momentum is not positive. That asset is considered bad. In the paper's main, most protective configuration, they use a 12-month look back on monthly data. PAA doesn't rely on one market. It uses a global multi-asset universe of 12 risky assets, covering US equities, international equities, emerging markets, REITs, commodities, gold, and even credit and long Treasury exposure as risky components. Then it uses a cash-like safe harbor, but not literally cash. The paper primarily uses IEF, an intermediate US Treasury proxy, because Treasuries often act as a hedge during equity stress. Here's the innovation Keller and Keuning emphasize. Don't only check each asset, check the whole market environment. They count how many assets in the full 12-asset universe have positive momentum. That number, called breadth, acts like a global risk-on versus risk-off gauge. When breadth collapses, PAA doesn't just trim risk. In the most protective version, called PAA2, it can move the portfolio entirely into the safe Treasury asset. Now the rules, in plain language. This is the version the paper highlights as a term deposit alternative, PAA2, using 12-month look back and top 6 rotation. Every month, 1. Compute momentum for all 12 assets and count how many are good. 2. Use that breadth count to decide how defensive to be. In PAA2, if breadth is weak, specifically if 6 or fewer out of 12 assets are good, the strategy goes 100% into Treasuries. 3. If breadth is healthier, the strategy invests in the top 6 good assets, equally weighted, and the remaining portion stays in the safe Treasury holding. Everything happens on a monthly schedule. The authors define absolute return in a very specific way using rolling one-year outcomes. They want at least 95% of all rolling one-year returns to be 0 or higher. That's win 0. And they want at least 99% of rolling one-year returns to be better than -5%. That's win 5. So the bar isn't never down. It's rarely down and very rarely down a lot. Here are the headline numbers reported for PAA2. In the papers in sample period, PAA2 shows a 17.1% CAGR with about 9.2% volatility and a max drawdown around 10.4%, while meeting the absolute return style target strongly. Out of sample, where it really matters, the CAGR is lower at 10.5%, but risk stays controlled. Volatility around 7.9%, max drawdown about 8.8%, and win 0 stays above 95% with win 5 near 99%. Across the full 45-year sample, PAA2 compounds at 13.7% with a max drawdown around 10% and win 0/win 5 of 96.0%/99.4%. The big story is the drawdown control. In the full sample results, the classic 60-40 portfolio shows a drawdown near 30%, while PAA2 is around 10%. SPY alone is far deeper, around 50% drawdown in the sample. This is exactly what the crash protection is trying to do: limit the depth and duration of major losses, even if that means you may lag during strong bull runs. One final implementation detail from the paper: the default safe holding is IEF, but the authors also test shorter duration Treasury exposure like SHY, and even switching between SHY and IEF based on momentum. Their conclusion is that SHY/IEF can be a safer bond approach in certain environments, while IEF remains attractive as a liquid hedge-like core.